Even the most adamant bears have been surprised by how long this rout in emerging markets has gone. Stocks, bonds and currencies continue to lose value as the predicted rebounds fizzle out and momentum made value irrelevant. Just how bad can this really get? Will there be any light at the end of the tunnel? Who better to ask than our emerging markets editor, Sivabalan. He joins me now from our London studio. Srini, good to see you this morning. Look, we've heard so much about the famous resilience of emerging markets, quick sell-offs, quick rebounds, but this rout seems as if it's going on forever. Put it in context.
Oh yes, Manners, great to be back, and I'm very happy to talk about it. The rout in emerging markets has surprised not just the bulls, even every bear in the market. Not just by the percentage of change, but by the amount of time it has gone on for. In the last 10 years, since the financial crisis, there have been 7 major sell-offs. You know, you had the taper tantrum, you had the euro area debt crisis, and so on. But none of those sell-offs has lasted as long as this one has. Why is it important? You know, short, intense sell-offs also lead to short, intense rebounds. They don't leave scars. So it's par for the course. They're part of the normal volatility of the market. But a slow, lingering sell-off like the one we are seeing now can do much more damage because it makes people take a step back and ask, why am I in this asset class again? You know, that's the problem. And that reassessment is going on now.
Yeah, why am I in this asset class? Yeah, that is a great question, especially when it all begins to unfold. Look, the sell-off has overshot all of the historical averages. As you said, the duration here is pretty intense. Is it running out of steam anytime soon?
Well, nobody is willing to make that call now. But we looked at history to get some clues. You know, we played the emerging market stocks index, MSCI emerging market stock index, against itself, but at 2 different points of time. In this chart, you see the white line. This is the MSCI index at the present time, and the blue line is the MSCI index during the dot-com era. And see how eerily similar they are. You have a 2-year rally driven by technology shares, mind you, peaking in late January, a bit of a wobble, and then a rebound, and then a true sell-off takes hold in April. This is the script that the dot-com bust followed, and this is the script that the market is following now. So if you extrapolate that and surmise that emerging market stocks will follow the dot-com pattern for the rest of the this sell-off, there's bad news because the sell-off is going to go on for 1 more year. There will be mini rebounds along the way, but a sell-off nevertheless. There you go.
Well, okay, that all just sounds pretty ominous. I'm gonna ring the pension advisor afterwards and say, what percentage have we got in EM? Let's cut that. Look, when a rebound does start to emerge, and as you said, there might be several on the way to a pretty tough time, where do you think the first signs come from? In other words, what signal should I be looking for from the markets as to whether they bottomed out? I mean, some people on the MLive blog this morning are talking about the credit default swaps having ratcheted in some of the bats, but maybe dropping in Argentina, for example, yesterday. Where are you looking at for the bounce?
Oh, yes. The single biggest unknown in emerging markets now is the trade war. The battleground is China. So it's probably reasonable to expect that the first signs of a rebound, a sustained recovery, will also come from China. And that's what this chart shows. The correlation between the yuan on the one side and emerging market stocks, currencies, and bonds on the other side is at a record high, at least going back to the 2005 depegging days. What that suggests is if there is a sustained recovery and signs of strength in the yuan, then probably emerging markets will also start rebounding. So watch out for the yuan.